All right, so I'm going to start with one of those questions that just might make you groan. So, how many of you want to be trading for a living, but you aren't quite there yet? I've been doing this for over 20 years, so I'm curious to see. How long have you guys been trading for? Grown. Oh, we got a lot of newer traders here as well as some that have been here for a good while. That's awesome. 1 month and blew the accounts. Yep, that can happen really early on. All right, so we got a lot of yeses out there. Well, like a lot of you, trading didn't come easy for me. It wasn't something that I was just instantly successful at. You hear those stories out there, but really a lot of those instant success stories, you go follow up on them a couple months later, a couple years later, and they're gone. You know, for me, it was a journey, and failure just, it really wasn't an option. I was stubborn. I guess you could say, some might say that I still am. It took a lot of years, a lot of sleepless nights, AKA market induced insomnia, and a lot of trial and error. I have two people though that I want to thank for my success, and I haven't mentioned them nearly enough, but my mom was a teacher and she was also an entrepreneur. My dad worked for Iowa State University and he oversaw the engineering department. So, he was working with computers office also at the University of Iowa way back in the beginning and just starting to develop them. So I was introduced to computers and programming from an incredibly young age. And in addition to that, he was also an artist and an entrepreneur and ran his own computer company. Well, neither one of them, even though they ran their own companies, they weren't out to make a fortune. They firmly believed that by helping others, your life would be better for it. And from them, I learned that it's important to pick a career that you love and to do it because you love it. I also learned that it's important to share that love and that knowledge with others. And I learned that an artist's eye certainly doesn't hurt. So tonight, I'm here to share with you guys some of what I learned over the past 20 years of trading for a living and the artistry that is constantly at play in the markets. So, what we're going to talk about tonight is looking at a particular strategy that I call a phoenix. Now, there's a lot of strategies that are out there in the markets. There's a lot of ways you can trade. I personally like to keep things pretty simple. I don't like to rely too heavily on indicators, get too wrapped up in what those indicators are trying to tell me. I'll use them occasionally as an educational tool just to help teach other traders things like time development, which I'm going to talk about here just in a little bit. But indicators as a whole are something that I use as like an additional tool. They're like a crutch. Like if you're an artist, especially if you're a realist artist like I am, then you use grids when you're working at portraiture and you're looking at them in like different sets and frames. And when you're using indicators in the market, a lot of times those can help provide like those overlays like a grid can do to help you make sure that you're arranging your portrait properly. So we'll see perhaps a couple of indicators in tonight's session, but you're not going to see too many of them. And really, they tend to be something that is more a confirmation tool versus something that I'm taking a trade based purely upon whether there's an indicator there or not. So I trade all different kinds of markets. I started out as a stock trader. I was focusing primarily on holding for several days at a time, swing trading. My original site was swingtrader.net, which I started as just a free site. I guess it was the equivalent of what you could say is a modern day blog. Back then, they didn't really have blogs, but it's a modern day blog. And from there, by following those markets every single day, I started following the futures as well. And of course, that led me into trading futures. And as soon as the Forex market became more regulated, well, I jumped into that one as well. And of course, that insomnia that I mentioned earlier, that kind of helped with getting into futures and Forex trading a lot more as well, since I was often up trading in the middle of the night. And even when I was running a trading room back then, like what, 12, 15 years ago, a lot of the traders would find me in the room in the middle of the night trading Forex. So what's interesting about my style of market analysis is that I developed it by trying to go past what some of the basic education of the day was, which was things like buy a pullback into a 20 period moving average. There wasn't a lot out there for technical analysis. You could find plenty on fundamental analysis, but of course, since online trading was pretty much in its infancy, there wasn't a lot on the technical side of things. So that really meant a lot of trial and error and trying to figure out patterns that were happening in the market and just learning them myself, as opposed to trying to rely upon things that really weren't practical to try to apply to the market. Some of you guys will see things like where you will see the influence of what might look like Elliott wave in my trading. Now, I didn't know anything about Elliott wave when I first began trading. It's something that, about 10 years into trading, I'm looking at and learning, and I'm like, oh, hey, yeah, there's some overlap there. But even when you see me do wave counts, it's not pure Elliott wave as you know it. So I'm going to teach you guys a lot of things here tonight. And my goal is that you can take away things from tonight's lesson and apply it to your trading immediately starting tomorrow. So getting back to this concept that I want to teach you tonight, we are going to be looking at a strategy that I call a phoenix. Now, you're all probably familiar with things like cup with handles, reverse head and shoulders. Those type of strategies can all be a part of what can end up being a phoenix trade. So when you have a cup with handle, for example, you're going to be looking at something like this, where the market's been heading lower, it pops up, and then you get this trading range or the handle. So this handle formation here is actually what we're going to be calling a phoenix. Now, the reason that I use the phoenix term for all of these different things, like here's your inverse head and shoulders, your shoulder, head, and the shoulder over here is your phoenix, is because the characteristics and traits that I look at that go into building every single one of these is the same. So it doesn't matter if the phoenix is part of a cup with handle, if it's part of an inverse head and shoulders, or if it's just this V pivot and then the period of congestion. So a phoenix is essentially the first continuation of what becomes a brand new trend, a brand new uptrend in this case. So basically, we're going to be looking for strong momentum coming off of lows, more gradual momentum in a correction, and then the kickoff of the phoenix trade is the continuation of this initial move off of the lows. So let's dive into what this strategy looks like. How many of you guys were participated in some of the other Phoenix classes that I gave over the last week or so? I've taught this class a couple of times over the last couple of weeks, but you guys are going to get a new version of it. So I've got new trades from this week to share with you, as well as showing you how those trades related to what we discussed over the last couple of weeks as well. Oh, great. So I see some of you are here from the Wealth 365, and some of you are here from the event last week as well. So great, you're going to get this in another version. What I love doing with my classes is that each time I teach a concept, I like to take trades that I've taught in previous versions of a class, as well as adding on new trades to it. I find that if you have the opportunity to go and view several versions of a class, you pick up on different nuances every time. So it's really beneficial to show you guys not only just like some of the static trades from previous class, but also how it's unfolding and how it's relevant in today's market, no matter what market that is. So I've given classes where I've taken trades that I took 4 years ago, 5 years ago, and used them in classes that I'm doing today and showing them side by side with strategies that are happening right today. Because the type of market analysis I use, you guys, is really truly timeless. And once you understand the price development and the building blocks that go into these strategies, you're going to be able to apply them to every single market, every single time frame. And in fact, even when you're looking at, like for those of you that might be getting into trading the Bitcoin, we saw a pretty dramatic reversal in the Bitcoin recently. And I was able to talk to my traders about that reversal coming up by sharing with them the reversal that I gave in the NASDAQ back in 2000 when the NASDAQ topped. In fact, if you go back in your own charts, you look at that NASDAQ top back in 2000 and you compare it to the daily of the Bitcoin, you're going to notice very, very remarkable similarities. So really, the strategy today is truly, truly timeless. So when we look at a Phoenix or any strategy for that matter, I look in terms of building blocks. So if you're an artist, for example, you're building a portrait. You're not looking at the entire portrait by itself. You're looking at the undertones, you're adding layers, you're looking at different nuances, different traits and characteristics that go into that portrait. Well, the same thing happens when you're building a strategy in the market. You're looking at those different undertones that are going to be showing. And one of the very first ones is the trend development or the trend placement. And that means, where is this bounce and more gradual correction taking place on the larger time frames in a larger trend? Now, a Phoenix can take place in a couple of different places. It can be a reversal following a downtrend, like you see here. It can also be something where it might be that last little pause before a larger trading range breaks out. And in fact, sometimes it's both. Sometimes this is the initial move off the lows, then you've got this larger Phoenix, and you've got a smaller little Phoenix within that larger Phoenix. Those are my favorite ones. I'm going to show you guys a couple of variations of that as we go through tonight, but that's like, if I see that, I don't want to miss that trade, basically. So you guys, from the Wealth 365, you saw this chart here. This is the euro dollar, and I'm going to show you charts with different trades in different markets. So that first thing that we start to look for is that trend development. And the first thing that you often notice is a higher low. Now here I've marked higher high as well, but you don't always get a higher high with a Phoenix. Sometimes it might pull off of this low here and base or conjust along here, and you'll end up with a higher low, but you still have a lower high. So we're not actually at a new trend yet. The Phoenix is what triggers the new trend, because when the Phoenix follows through, that establishes that new higher high. So then at that point, you have a high and a higher high, a low and a higher low. So then you finally have that uptrend having been established and now developed. So we were really looking at the very new stages of a trend as it's just getting started. So this is when the risk tends to be the least for trend traders, is when you can take advantage of those first continuation moves that kick off that new trend. Now, momentum is the next building block that I look at. With momentum, we're looking at the rate of change that something happens in the market. So in this example, we have some V action back and forth and back and forth. Now you'll notice that overall, this channel is actually starting to shift compared to what we saw on the downside a little bit earlier. So it has a little bit of that cup with handle type of feeling to it. This additional shift in momentum here is really positive because it helps get this strong follow through once the Phoenix triggers. So with the Phoenix, what we are looking at is an increase in momentum coming off of the lows. That can be an average momentum move compared to these previous V type of moves, or it can be a stronger than average move. For example, sometimes these might be a little bit more gradual, and this will be a stronger impulse move to the top. The next thing you want to see is a more gradual correction. Now here's where something might get a little bit tricky. So what you'll notice is that when this pulls back initially off of this high, that pullback is pretty rapid. And in fact, when it pulls back again, it's also pretty rapid, especially when you compare it to this overall uptrend move. So what I'm looking at is not those smaller impulse moves within this larger correction. I'm looking at the momentum of this larger correction as a whole. And I'm looking ideally for two waves, 1, 2, as that pulls back. Now, after I have that second low, that's when I'm going to start to look for entry triggers. A lot of traders will get a little bit too aggressive, I guess you could say would be a good word, and they'll try to buy when they only have that first initial pullback. Well, this is where trend development comes back into play because corrective moves often come in waves of 2. So if you buy after that initial pullback, you might start seeing it hitting a support level, seeing momentum stall there at that point, even seeing reversal strategies on a smaller time frame that indicate that it's going to bounce. But if this is only one wave down, there's going to be a really good chance that you can see a second wave follow it. So you want to be prepared for that potential. And an ideal strategy would be to wait until you have that second wave in place before you enter the trade. Now, let's go on to the next building block for the Phoenix, and that is going to be looking at time development. Now, this is probably a new concept to a lot of you. I know it's not something that I had ever seen taught before. I don't know if people are starting to teach it now, but time development is basically where you are looking at periods of correction and you're looking at previous impulse moves and you're comparing them. So when we look at an impulse move is a primary directional move. So it can be a strong move on the upside, strong move on the downside. Usually when you have these V's, those are pretty good indications of what a typical impulse move is going to be. So in a Phoenix, we're looking at a strong impulse move to the upside followed by a correction. So to determine the time development for this Phoenix and if it has developed long enough to sustain a major breakout to the upside, it's a good idea to go back and look at previous impulse moves that are similar to this one, such as this move off of the highs here, and look at how long that took to develop before you finally started to see another continuation move. This strategy here actually is the opposite of a Phoenix. I call it an avalanche. So it's basically the Phoenix turned upside down. All of the traits for the Phoenix are going to apply to the avalanche as well. So with this congestion here being mimicked over here, that tells me that this point in time is a really good spot for momentum to kick off for this Phoenix. Now you'll notice that with this two-wave correction, that you might have some entry triggers that happen before that time development has really played out. So that just means that you might get into a trade a little bit early, and it might take a little bit longer before you see the follow through develop. You might see, for example, it could go and create an inverse head and shoulders within here with another little tiny phoenix over here. That is pretty typical. In this case, we had a little bit of a smaller version of that where it pulled up, had a little base here, and then offered the breakout. But more of a traditional inverse head and shoulders is also very, very common. So keep an eye on for that as well. And it can give you an area where you can build into the position. Or if you miss the initial triggers, then that can be a level that you can go ahead and purchase it. Let's go and look at those entries. So there's a number of different entries that you can use for Phoenix. The first one is to look at that trend development and look for those two waves of correction. Now, when your second wave of correction is basically a mirror image of your first wave, where the momentum is the same and the distance between the highs and the lows is pretty close to the same, then you can do an early entry on a break of that trend channel. So as it's coming off of that second low, when that channel breaks, you can do an entry at that point. Now, this is a little bit of a more aggressive entry, but it's by far the earliest entry for Phoenix. Now, a less aggressive entry is to look for something like a smaller Phoenix after that point. Now, sometimes you don't have this strong continuation move. In fact, sometimes your Phoenix might look like this. And so in that case, you've already got that shift in momentum. So you can take that breakout from that channel at that level. But if you have the two waves where it looks a bit like a lightning strike on the way down, then be prepared for the possibility that you might have something like this happen where it could go into an inverse head and shoulders before it breaks. So that gives you your second potential entry. It can be a place that you can build onto a position. Sometimes this will bounce back up to this previous high, and traders that are just trying to look to build confidence, that might be a good level that you want to take off part of your position and then look to add back into it on another breakout. You know, everybody has a little bit of difference in terms of their comfort level for how they manage trades. The nice thing with a trade like the Phoenix, though, is that there's so many ways that you can trade it and still be successful because it is a very, very high probability strategy. So the third entry trigger, this is the one that I don't like to use a lot, but it's the one that everybody seems to teach when they're teaching like things like bull flags and trading range breakouts. And that is connecting highs, basically creating a trading channel and buying the breakout from that trading channel. Of course, the big problem with this is that you are buying at resistance. So a lot of times these previous highs are just overhead. So you will get moves up and then it'll pull back down. And this becomes a big problem for many traders because they don't want to take a loss on a position that was already profitable. So that can lead to getting flushed out of positions. It can lead to initial emotional distress, especially if you're a newer trader and you're really not that confident in your trading yet, because you have to hold through some of these corrections and those pullbacks before you can get another continuation. A lot of times this will go through like this. It'll pull back down like this before it goes again. So if they move their stop to break even, they're getting flushed out. So this tends to be my least favorite entry, but there are definitely times that I will use that. That tends to be if this is more of a range like this where there's a lot of back and forth action and it's not as clear cut on the smaller time frames where you can see another smaller clear pattern like an inverse head and shoulders. So that's the only time that I would use that, and it usually tends to be on a smaller time frame again as well. So stop levels, the initial stop you can use is under that two-wave pullback. Then if you get a smaller Phoenix, you can actually move your stop up on the entire position if you're building into the position, Or if you're entering it at that level, you can use just under that last little portion. A lot of traders will want to say use under the entire congestion. It's not necessary. It does not increase your chances of success substantially. It doesn't reduce your odds of getting stopped out substantially, but it can dramatically increase your reward compared to your stop. So you can take something, for example, it might be a 2-to-1 return compared to your reward if you're keeping your stop under the low, and you can tighten it up and sometimes get 4-to-1, 5-to-1, 6-to-1 if you get a really tight continuation Phoenix. Now, target level on this. So a traditional target level is going to be looking at that impulse move that takes place before the pullback for the Phoenix, and then doing 100% trade extension. The Fibonacci extension can be a tool that you can use to identify those levels. And that's going to be the typical target level. So that's going to be the one that hits nearly all of the time. Now there's many, many cases that it goes past that level. For example, you can see here on the euro dollar, it easily surpasses that level. Typically, it does that because of what's happening on the larger time frame. The Phoenix, keep in mind the Phoenix is a reversal strategy. So you're looking for a reversal off of a low, which is often off of a larger trend on the downside, and you're looking for a really strong reversal. So many times this Phoenix can be a really small pattern in what ends up being a much larger reversal. You'll notice here, for example, this is the euro dollar, but I've gone up to the larger time frame. Well, here's that little Phoenix. So you can see that little Phoenix, 100% measured move, would put it right around here, which is a resistance level. It's a resistance level from that previous high. But in the grand scheme of things, this is just a little Phoenix that is taking part within a much larger period of congestion. So the breakout from this Phoenix is actually triggering this two-wave correction here. So instead of looking for just that measured move on the smaller time frame, I looked for the measured move on the larger time frame, comparing it to when it went into this whole entire period of congestion in the first place. And you'll notice that it held that literally to the T there. It was perfect. And this happens over and over and over again. If the momentum were slower coming out of this, and I'll show you an example of this here in a minute, then usually that target level is going to slip to that 76.4% level. So sometimes if the momentum is weaker, whereas here it's about the same, but if the momentum is weaker, you can still use these Fibonacci extension levels really well because that 76.4% level is a very, very strong one. Now let's look at another trade here. So this one is from this week. So we're going to look at the initial trade here triggered on Friday, but there was a continuation here earlier this week with a bigger Phoenix. So I'm going to show you guys this one, and we're going to go through all of those building blocks again, but using this trade. So on Square, and I know some of you are fans of trading Square, so I wanted to make sure I included some of them that you guys like to trade as well. So Square here had this really nice downtrend move on the 5-minute time frame. And here it had this initial higher low. One thing you'll note is the momentum is picking up off of this low, and you've got that two-wave correction. So even though it pulls down pretty quickly off of this high right here, it starts to slow here. And that is really, really ideal. I love to see that momentum slowing because you usually get a much stronger breakout and you have less of a chance of that extra shoulder forming or another little tiny Phoenix forming. It has a better chance of just going like we see here. So there's the initial trend development that you look for. And then here's the momentum. So you can see that there's a strong impulse move off of the low, and it's really the strongest move on the upside compared to all of these upside attempts at correcting. This is the one where we finally see true force to that bounce. So it's really key that we have that shift in momentum here with the buying. So here is the more gradual, slower correction here. And this is, again, the key start. Now, you'll notice that this is still a downtrend because we still have the lower highs and we still have the lower lows. It's not until after the Phoenix follows through that you have a new uptrend. So technically, you're entering a trade that is still within a downtrend. It's just you're looking for that higher low to hit, to finally start and kick off that new trend. Now, here's the time development on this one. And we have a few more things that we can compare than we did on the Eurodollar. So with Square, we're looking at the 5-minute time frame here, and you'll notice that it has a lot of periods of congestion. In fact, here's one that offers a continuation a little bit later on after our Phoenix. And on larger time frames, you might not have even seen this Phoenix down here. You might have only seen this continuation here, which might have presented as a Phoenix. When I was first looking at this in review and dropping down to the smaller time frame to grab that smaller time frame, on the larger time frames, I didn't even see the smaller Phoenix until I got down to the one that the trade was on. So with the time development, basically what we're looking at is, here's an impulse move, here's the correction. Let's look at, previous impulse moves, previous moves, and how long it took corrections to form before another continuation move happened. So this is really important in terms of making sure you are not too early to a trade and then hence getting flushed out if it goes to a slightly lower low. Now, when we look at the entry trigger on this one, I went down to a smaller time frame here, so you can see it on the 3-minute. This is a typical time frame that I trade a lot of the intraday trades on. So I'm usually using 2-minute, 5-minute, 3-minute, and I'm a big fan of using tick charts as well, especially when I'm looking at Forex and futures, because the way they display the aftermarket data, I can see patterns forming on sometimes on a tick chart that might not show on a time frame chart, and vice versa, and both of them are equally valid. So it gives me basically double the opportunities of finding really strong trades when I'm using both the tick charts and the time frame charts. Oftentimes, time frame charts can smooth out action as well that you might not see, especially if you're dealing with a security that maybe is a little bit thinner than something else. So that can be an advantage as well. So here on the 3-minute time frame, you can see really clearly the shift in momentum. And this dictates here where the entry trigger is for this Phoenix, as well as the confirmation for the continuation trigger. So I showed you there's 1, 2, 3 ways that you can enter these Phoenixes. The first way is that channel break from the second wave. The second type is to look for a smaller Phoenix that could be forming within it. So up here, even though this is the continuation move, you can still see how that pattern would play out. So you could take this entire thing, and sometimes that's what's going to happen down here. So even though we technically have a flag continuation up here, this pattern could just as easily be the formation down here at the lows. So this would be that smaller Phoenix that would form. And then here's number 3, that would be that channel break. If we did that over here, you're basically looking at the same time as the smaller Phoenix. So that's like one of the only times where I will draw that channel and it will look like I'm taking the channel break as my entry trigger, when in reality, I'm taking it because of the smaller channel break. And then of course, another option is that sometimes you can get these smaller little corrections before the bigger range really breaks these highs. And that's another great place that you can build into a position as well, or add into it, or catch it if you missed the earlier triggers. Now for stop levels, we're going to be looking at under these pivot lows. And you're going to notice that I use different stops for every single one of these. So the initial Phoenix down here, the stop is under that entire low of that Phoenix, basically, because that second low is lower than the first low. Now, over here, when you look at the bull flag and you look at the continuation, you'll notice that I don't use under that entire low. I use, first of all, under that second pivot low, which is basically the same concept as I'm doing over here. And as it moves forward, you can adjust your stop to under that next little base, that next correction here, as that breaks higher. So when this breaks to the upside, you can move your stops up to under those tighter lows, and you're not going to increase your risk at that point of getting flushed out very easily. So just keep in mind with this that even though this is the second continuation, that is basically the first continuation of the new trend, this same pattern is one that could very easily happen down here. All right, now let's look at target levels. So when I was entering this trade, I was actually looking on a much larger time frame, and I was expecting a lot greater return on this. So what you'll see here is that, like I mentioned earlier, a lot of these trades will trigger larger trend reversals and larger trend corrections. Now, sometimes you're going to find a Phoenix that actually ends up just being part of, like it might happen in here, it's part of a two-wave correction off of lows, and then the low trend reverses and continues lower. So here's your little Phoenix, but it ends up being a head and shoulders. That happens if your trend exhaustion isn't strong enough on the larger time frame. So that is a place that you can find the Phoenix, but that Phoenix will just give you that one-to-one measured move. Whereas when your downtrend is more extended and you're seeing momentum starting to slow at the lows, that's going to give you a lot of these really stronger ones. So here would be initial typical target. Again, this is the target level that's going to hit most of the time, even when you're dealing with, let's just say this went up here and had a little Phoenix like there. So it might go and hit that measured move before it turns around. So that's what I'm usually looking for. And again, that depends a lot upon the momentum. This momentum needs to be just as strong as the momentum over here. Same thing if it was happening over here. If that momentum shifted and slowed, then there might be a problem. So if you have something coming up like this, for example, and the follow through is more gradual, then that's where it might go to only that 76.4% that I mentioned. Now, with this, we had this additional continuation here. And so this shows you how a lot of times those measured moves hold almost perfectly once again. So just like on the euro dollar, you have the same thing happening here, where the continuation gives you that 100% measured move. So I added this here to show you guys how you can use that Fibonacci extension tool. So basically you go from the low of the impulse move to the high of that impulse move. And then you go to basically the second or last low within the congestion. I don't use that first low, even if that's the lower low. I always use at least that second low, and sometimes if there's like a decent inverse head and shoulders, I'm even going to use this low to give me that continuation, because that's the one that usually gives me the best measurement, because that's where you see the new impulse move kicking off. So by using that second low, you're going to be able to help identify that target level much more clearly than you would if you just used the first low or anything else within that trading range, basically. All right, now I also want you guys to see this larger phoenix. So this is the one that that a lot of my attention was focused on. And it's because I usually use larger time frames and then drop down to smaller time frames for the entries. So what I was looking for was something that was a stronger reversal off of a larger low. So we had a downtrend in play on the 10-minute time frame, and I was initially saw it on the 30-minute time frame, but I had that downtrend in play on the 10-minute time frame. And we're going to go through all those building blocks here again. So there's the downtrend. Here's the V low. So we've got the impulse move now kicking off on the upside as compared to some of these previous corrections where they just really couldn't get going. And then we had the congestion begin to form. So you'll notice really quickly that this phoenix here looks a lot like what we saw in that smaller continuation on the 3-minute time frame. So absolutely you can get this version playing out as well. Now, time development wise, we had this impulse move off of the highs, which is pretty similar to some of this impulse move coming off the lows. And here's how long it took before we really saw momentum again coming in. I often think in terms of waves of two. So a lot of times you'll see 2 waves going down and you'll see 2 waves coming out. So with 2 waves going up, I'm usually expecting 2 waves coming out. Now, with this period of congestion, of course, this initially had this 2 wave here, which would have kicked off an early entry. And basically that would have been if this had had another pullback in here, you would have seen that that time development there would have been right about the same as well. So this one was a little bit more gradual, which is again what I like to see a lot more. And that time development though was still pretty close to what we saw here for where an initial entry took place. But since it took a little bit longer for the momentum to really get going, then that tells me that this could also take a little bit longer for the momentum to get going, that I might not have that immediate follow through. In fact, that I probably wouldn't have that immediate follow through because of that time development. So I waited, I was patient, I kept holding on to this, and you'll see that the next morning we had a move where it pulled up and offered a couple of additional triggers. So it had an additional trigger just by that pure channel break as that was moving up, which is very similar to what was happening right in here on that smaller time frame. And then it also had the pure channel break for those of you that look for that. And this would be an example where I would be okay with doing a pure channel break had I missed some of the earlier triggers. But the problem you'll notice is that the stop on that would still have to be under this low. So granted, I'm looking for an initial target zone in here and a secondary target zone up here. So there's room for it, but it's only about twice what the distance is between my stop. So if things don't follow through really well, it might not hit that. And that's always a concern for me going into trades like this. I don't like to keep the stops that are that wide compared to what I'm risking. But sometimes that's what you have to do. Especially, I find that happens a lot more if I'm trading futures as well, like especially with the S&P 500 futures. A lot of my trades end up being 2 to 1, sometimes 1.5 to 1, what I'm risking, because I'm trading a lot more setups that are more like entries like this. Now, you'll notice that this doesn't get to that 100% level right away. So here's, with this, we have a two-step move into the congestion. So usually the first measured move is going to be a measured move of that last step going into it. You can see it fell a little bit short. So this gives me pause when this type of thing happens, especially if momentum starts to change there, because it tells me that even though it can still go for larger target levels, it might take longer to get there and change the overall momentum coming out of it. So we've seen this happening before on, for those of you that were in the previous classes on the Phoenix, I showed you guys a few examples of that happening. And that's what we're seeing here as well. So basically what it's doing is that by falling short of that 100% level and then pulling back further than it did for this small correction here. Now going back thinking, again, waves 1 of 2, right? So you got waves 1 up, 2 up, 1 up. Well, if this had had same momentum, the second wave would have been right there. And this, instead, it pulled back, based a little bit longer. This is where having those break-even stops can really, really cause problems for a lot of traders again, because even though there's still a good opportunity for this to go further and keep going, it doesn't hit the original targets they're looking for and it starts to pull back, so that creates panic. But in most cases, as long as your larger time frame is working in your favor, there's not really a big reason to panic. There can be a reason to adjust what you're looking for as target levels, but not to panic and get out of the trade. So with something like this, I usually end up having to adjust my target. And this is where I'm now looking at this as an overall shift in momentum. So even when this picks up momentum over here again, I'm still looking at this as a shifted momentum move. And a lot of times I'll look at this smaller impulse move now and look at where that puts in a measured move, and I will use that to start to take gains on a position. In addition to looking at what we have overhead for some of these Fibonacci extension levels. So here again, you can see it hit that 76.4% level and it held that perfectly. So when momentum shifts, that 76.4% level becomes that secondary target that I'm looking for when I have to adjust that target. All right, hold on a second, guys. I'm gonna switch over some of my charts here. And I'll show you guys a recap that was another one recent in GM. So here's another example of a little bit of a variation of a Phoenix. So here we have kind of a shift in momentum almost immediately as it comes off of the lows. And there's really strong support in here on the daily time frame because it's at that retest of the lower end of this trading channel. Now, what's interesting here though is that a lot of times these third tests of support and resistance are the ones that are more likely to break. So you always want to have more caution as something is coming into the third test of support or resistance. Overall though, momentum was shifting where the channel had these nice 3 pivot lows here, and then momentum was really, really strong off of that low. So this trade caught my eye pretty early on in the day because of that strong shift in momentum right away, but it didn't offer a trigger until later on. So it took a good portion of the day for that momentum to play out, for it to develop a really nice Phoenix strategy. This is where a lot of traders get stuck a little bit early because they will take these channel breaks from these pullbacks, then it won't get going. Then they get worried and end up flushing out. Sometimes it goes to a slightly lower low. So if you wait for that second pullback and that second period of congestion, that's where you're going to have a much better chance of getting a really solid entry. So here's another example where things went a little bit further than expected. It pulled up to that 61.8% very, very, very quickly and then paused. And then when I have something like this where it pauses like that, just like I showed you on the last one, a lot of times what I do is I look at this impulse move that was the continuation, and then I look for a measured move for that. And then I use that as my next target level. So it's part of trade management and understanding trade management as things are progressing, how you can adjust those target levels as a trade unfolds. So you can see that this went to that 100%. based upon this larger move over here, but it also was that 100% on that smaller move now. And when it hit that, that's where momentum began to change again. Now it's kind of hard to see here on the 15-minute time frame, but on the smaller time frame, you ended up with more back and forth action here. It made it to the 123.6, but it did it with a lot of overlap. So it was really that 100% level that served to stall that momentum and to really get it shifting. All right, I'm reading through some of your guys' questions here. So I've been watching the chat box, and let's see. I love that you guys are learning a ton already. Okay, so there's one question that keeps popping up, and that's essentially that you guys get the basics and they're making total sense to you, but you feel that maybe you're still missing something, and you're asking about how you can take what you've learned tonight and apply it to your own trading. Okay, well, that's a really great thing to think about, and I'm going to come back to that in just a minute. First, I want to thank all of you for coming tonight. As much as I love trading and the flexibility that's given me in my life over the last 20 years to pursue so many other things, teaching is really my second passion. And I truly believe that sharing my knowledge has helped me grow and continue to develop as a trader. And I love to see you guys grow and thrive as well. And this week was particularly special because I received 3 separate messages from traders I've been working with for the last couple of months. And they all used the same phrase. And that was, "It finally clicked." And all of these messages were referring to different aspects of their trading journeys. They weren't all responding to like one particular thing, but don't you guys just love those "it clicked" moments? It definitely made me smile seeing so many of them at once, and I hope that you guys are getting some of these "it clicked" moments from today's class as well. Now, I know you guys are catching on to the basics of this Phoenix strategy, and many of you have seen it happening over and over in the markets, even sharing me examples that you saw from today in chat. I'm seeing some of you guys are posting some of them up here today, but at the same time, you're asking me, where do you go from here? Where can you pursue things further to learn not only additional strategies, but also more of the intricate details regarding trade management and how to adjust expectations as the market evolves, just like we were talking about here, with adjusting your target levels on the trades. So what would you guys say if you had 14 more hours of lessons like the one that I shared tonight? Good? Yeah. Okay, well, so a few months ago, I listened to your request, and I created a market timing bootcamp. I know some of you in here have already taken that bootcamp. Basically, I took all the lessons I've learned over the years and poured them into a brand new workshop. So let me show you guys a little bit about that, and we'll go back here to your questions as well in just a second also. Let's see here. So I swear I'm not nearly as scary as the guy here in the picture. Well, if you ask my 6-year-old when I'm trying to get him to bed, he might say that I make a pretty good representation of this guy here, but I promise you I'm not that scary. Since you guys don't have a bedtime, well, at least not one that I've imposed, you're free to get started on the boot camp tonight. So here's what those classes cover. In the boot camp, I teach you guys, let me erase that, basically my unique style of market analysis that focuses on those building blocks of price development that I started to touch on today. As you also saw tonight, you must be able to understand and apply them if you want to trade the Phoenix successfully. So the same is true of so many more patterns out there as well. And yeah, there's many, many more. In fact, once you sign up for the boot camp, you're going to receive my market timing playbook. And This details all of my favorite strategies from start to finish. This manuscript is over 200 pages, and it includes details not only on the strategies themselves from start to finish, but also how those building blocks influence each of the strategies. So I list each of the building blocks in regard to how that strategy forms and show you guys what those pros and the cons are. And I've included examples of trades for each strategy so that you can see them in action, both in terms of pros and cons, because obviously not every trade is going to be textbook perfect. There's always going to be cons. If you look hard enough, even the most picture perfect ones are going to have cons. Whether they matter or not, that's the important fact. Now, if you're like me, you're not only a visual learner who likes to see things unfold in video, or talk face to face, with working with me live, but you also like to be able to pour over lessons in written format as well. I know I'm a huge fan of highlighters, jotting down notes in the sides of manuscripts, and maybe it's to appease the inner student in me. I also created a full college text book. It accompanies the course, so it's complete with review sections to test your knowledge along the way, and your confirmation email for the course will include the link to download the PDF, so you can read it on your favorite e-reader, or you can print it out and pour over it with your highlighter in hand. Registering is easy. You just go to tonihansen.com/5, which refers to those core building blocks that are at the heart of the course. So you fill out the form and then check your email, and that's it. So as you work your way through the course, I'm always available. If you have any questions along the way, just send me an email. So as you already saw, the retail value is $9.97. That's just if you purchased everything separately, but I've made it available to my internal list, which is you guys, for $197. Thanks, David. He just messaged me to say that he's covered 10 times that over the past week. That's really awesome. This market has scared a lot of people, but technically it's been an incredibly sound market, and strategies have continued to show really excellent follow through. In fact, I kind of skipped over a chart here a little bit earlier. Let me go back to that quick and show you guys where I wanted to show you guys what we have when this pattern has the opposite formation. So that's that avalanche formation. So the opposite of the phoenix is the avalanche. And the avalanche is the pattern that kicked off this entire free fall move here. You can see it on the daily time frame. Here's the avalanche on that really small time frame. And again, this is just the phoenix in inverse. So here's your two-wave pullback, your initial trigger with the two-way pullback, the stop. Here's that little smaller avalanche within it, giving the secondary trigger for the secondary continuation. So really, strategies like the Phoenix, they are relevant no matter what market you're trading and what's happening in the market. Even when the market goes absolutely crazy, like you have seen over the last couple of weeks, of course, if you guys follow Forward Focus and whatnot, it probably wasn't too crazy for you since we were expecting a really rapid flush out. But yeah, so do you guys have any other questions? I'm just going to scroll through here and see what else I can answer. Pretty name for the strategy. Thank you. Is there an alternate strategy to identify and predict the trend in the early days on? Oh yeah, so the Phoenix is actually a secondary reversal strategy. So in that market timing playbook, you'll see a couple of other additional strategies that are for reversal strategies that are even earlier. So you've got the 2B, the 2T, and the momentum reversals. Those are all three strategies that are really, really strong for trading additional reversals where you can get in on really those absolute highs or lows if you're looking for a reversal off the bottom. Let's see here. Bear with me a moment as I go back. You guys have had a lot to say, so I love that. So, okay, it's not an it clicked, but same thing here. So let's see. Steve says, and I have to leave, but this has been a very informative lesson as I trade Gartley's, and this is a great addition to where I can get in. It is something I've been frustrated with, but I just had a big aha moment. Thank you very much. Oh, so that's my fourth. Okay, it wasn't quite this clicked, but big aha moment is good enough. And so still working his way through the boot camp videos. Well, if you have any questions, definitely let me know. Can I show a chart of the Bitcoin? Sure. Hold on a second, guys. I will pull up a chart of the Bitcoin. You'll have to bear with me just a second because I don't have it on my current trading platform that I've got open. So I'm going to pull it up on another chart platform here. Yeah, because I talked about showing you, how the Bitcoin compared to what we saw with the NASDAQ years ago. So I'll even pull up the NASDAQ here to show you guys that comparison. So here was that massive swing up in the Bitcoin. And what you'll notice here is, what pattern is this, guys? Come on, opposite of the Phoenix. You remember? Avalanche, yes, bingo. So this is your avalanche strategy, and you can't get any more textbook than this. You've got your two-wave correction, you even have your volume dropping off, and then the continuation. So if I go and show you guys the NASDAQ, now I'm just kind of going back and forth here all over everything. We'll go back to that larger, all the way back machine. I can't quite spread this out enough that you're going to see a ton of it because it's really way back there. But we'll get it clear enough. So here, same pattern, and you can't see the two waves as easily on here. But think of it. Here's the green. So there's your bounce up. There's your red back down. Your green back up, and your red back down. So it had that same pattern. Exact same pattern as the Bitcoin. So when people are saying, what's going to happen to the Bitcoin, I'm like, it's going to crash. I mean, this is what we saw happening all the time back in the late 90s with all of the internet bubble stocks. I mean, that was how I was actually able to predict this turn in the NASDAQ back then. Everybody was just shocked that that happened. I wasn't shocked because I saw that same thing happening in so many of those internet IPOs, the tech bubble. It was crazy. I mean, you saw that exact same pattern that was happening on the NASDAQ on the weekly and monthly time frame. It was happening on individual stocks like left and right. So there was no shock to me. But I didn't come into the markets with like a set mindset. I didn't think, oh, the market always has to go up or anything like that. In fact, I was just looking at it just as basically a puzzle. So I didn't really care if it went up or down. So I think not having that initial bias to start with is really what allowed me to make so much progress as a trader, because I didn't care if the market went up or down. I wasn't attached to it as far as directionality went. Yep, I will pull back up that chart for you guys, or that registration link for you guys. So it's really simple. It's just tonihansen.com/5. And you'll get all of those with the login email. And then any questions you have, just shoot them on over to me. All right, I know you guys have a number of other questions. We're getting a little bit late on time here, so if you have anything else, I will be happy to address them in email to you. I'm actually going to take a screenshot here. If you guys have any you want me to email to you, post it in the question box with your email, and I will get it to you. When is the boot camp? So the boot camp is currently recorded, so you can access it and go through it self-paced. So basically, you'll get the login, and it will have all of the videos, so you can select which video you want. And each video has a specific topic. So it starts out really simply, and they build on each other. So the initial video then builds into the second video, the third one, the fourth one. And the final one goes into market analysis, where you are looking at trade development and trade management. So the final one focuses upon pure trade management and basically tying everything that you learned throughout the course of the boot camp all together. Can you ask me questions for the boot camp? Absolutely. Yep. All you got to do is shoot me over an email. Or you can message me on Skype too. Skype is actually really easy. Is this the same boot camp that was presented last year? Yes, so this was the boot camp from, I recorded it, what was it, December, I believe? Yes, for those of you, again, if you're asking additional questions you want me to answer, especially if it's anything off topic, then just send me your email address there in that Q&A box. I'll copy it and I'll shoot you over an email. Does the course also cover Fibonacci extensions and targets and stop losses? Yes, it does. So the market timing bootcamp does go into Fibonacci, and it goes into understanding targets and, as well as trade management. So when targets are not hitting and you're struggling, like you saw on the last trade, then it goes into how to adjust the management for those trades, how to raise your stop levels, how to get out of things earlier based upon clues that are being given that it's going to turn around on you. So a lot of that trade management stuff really gets discussed, especially in that last session. Can you sign up for the bootcamp and access it later? Absolutely. So once you buy it, you have indefinite access. So none of my courses have an end date, basically. You're allowed access to them for as long as you want to view them. I guarantee 2 years, just to, you never know what's going to happen way down the future or anything. But so I guarantee at least 2-year access. All right, guys, well, I'm going to go ahead and get going. I've got a little guy here. I need to get to bed. Did I mention the 6-year-old? He's a tough customer. All right, have a good night, everyone. And thanks again for stopping by tonight.